Hey, welcome to another afternoon and here on Thursday in Southern California. My name is Jeff Harrison and you are with us at the Mortgage Minute. I'm looking forward to a pretty exciting, it kind of reminds me of an exciting show with Art Alvarez of Mortgage Minute. It kind of reminds me of being at Disneyland on Magic Mountain. Remember those dips and turns, and that's what's going on right now. It's like, you know, it's certainly one day it's a brown shoe, the next day it's a black shoe, and you're like, how am I gonna make any sense of that? Well, that's why we have the expert on duty, and we're so excited to have him back. Last week he was traveling, and a guy that does what he does, he's in demand all over the country, and he was way out of state, and now he's back. So let's welcome back Mr. Art Alvarez. Hey, Art.
Hi, Jeff. Thank you.
Hey,
Good to see
welcome
you.
back. How was it last week for you?
It was good. I was back in Detroit attending a TPO roundtable hosted by one of my wholesale lenders, Flagstar Bank. So it was a good opportunity to, talk to and listen to folks from around the country, both, of course, a wholesale lender, a major wholesale lender, as well as, mortgage brokers from around the country. So we could, talk about the industry, what's going on with the industry, what the future holds in terms of this wonderful market we're in, and so forth. So it was a good experience. Learned a lot, and always good to share stories with other people in the industry. So.
Yeah, I suspect sometimes it feels like you're kind of in a silo, like you're all by yourself doing your thing as you're running your company for as long as you have. I mean, I'm sure you know people from all over the country, but a lot of times it's like feels like it's you against the world, or is that incorrect?
No, I think you're right about that. But what's good about these kind of events is that you get to meet some of those other folks that you don't necessarily compete with in your local market, but yet, although there was a couple of California brokers that attended this, so including one from Orange County, one up in San Francisco area, and so forth. So in a way, yeah, you're competing with these folks all the time, or at least in some markets. But at the same time, it's a very friendly and collaborative type of situation where you can, again, share stories and talk about problems that we are all facing and encountering in the current market. And
Mm.
so from that perspective, it can be very helpful. And, you do make contacts and people that you stay in touch with and, can seek out for advice or help and collaborate in the future. So for all those reasons, it's a good experience.
Well, we're grateful that you went, and I know that was a pretty exciting trip for you, and that they sought you out and said, "Hey, we want you here because of your background and what you do." So I'm looking forward to hearing more of that. Hey, before we get started, I just wanted to remind everybody this is a live show. I'll be ducking out of here in a second, but I'll be managing the comments, and so if you have any questions for Art on anything we're talking about, even if something's well, let's make sure we keep it around the home mortgage topic, if you will. I don't think he's given dating advice today, but he may. If it shows up in the comments, we'll see if we can put it on the screen, and then he'll answer that. Now, if you're watching this as a recorded and you still have a question, please put it in the comments, whether it's on Facebook or YouTube, and we'll be more than happy to get back to it. So with that, Art, I'm going to turn over the helm to you, and I'm going to say, let's have a great show.
Okay. Thanks, Jeff. Off we go. Well, hello, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Welcome to this week's Mortgage Minute. As Jeff mentioned, and of course, as we always start the show, I always like to check in with what's going on with mortgage rates. And so that's what we're going to start with again today. Again, here's our rate grid taken directly from the homepage of our website. So with this grid, you can see current indications, interest rate indications. And what you can kind of gather from this rate grid is that things haven't changed much since over the last couple of weeks, for sure. And so what's going on? This was actually a very interesting week as it relates to mortgage rates in the markets, because we had those 2 days worth of Fed meetings, which is always highly anticipated, and the market's braced for what's going to happen at the conclusion of the meetings. And so in that regard, it's an interesting scenario that we've seen for the last few days. Jeff's going to pull up the chart for the 5-day 10-year bond yield chart, so you can get an idea of what's been going on. And this week with the Fed meeting, what tends to happen is the markets, both the stock and the bond market, will tend to kind of go into a holding pattern and kind of wait for the Fed to conclude their meetings and make their announcements. And what's interesting is when you look at the 10-year bond yield, it as Jeff alluded to with Disneyland and Magic Mountain, It's interesting. Last Friday, the 10-year bond yield was just about exactly where it is right now, right around a little over 370, 372. But in between last Friday and today, boy, it just looks like a roller coaster, very up and down, very choppy. If that was a roller coaster I was on, I'd be trying to jump off. So what was going on there? Well, we had a couple of things going on kind of simultaneously. We had the Fed meetings on Tuesday and Wednesday, and then we had the some economic data coming out on Tuesday and Wednesday. We had the CPI on Tuesday, and we had the PPI on Wednesday. So what happened on Tuesday? Well, the CPI came out again lower than the month before. In fact, down to 4%. If you recall, in April, the CPI was 4.9%. So we actually saw a little bit of dip in bond yields on Tuesday, which is unusual because usually, like I said, the bond market tends to go into a holding pattern, waiting for the Fed to finish their meetings and announce what they're going to do. So then on Wednesday, we had the PPI come out. That was also lower than expected. It was down to 1.10. And that is a reduction from the previous month in April when it was 2.3. So good reductions in these two key inflation data points on Tuesday and Wednesday. So then what happens? Again, the market was betting on the fact that the Fed was going to pause this month and not touch the Fed funds rate, not raise it, not lower it. So they conclude their meetings, and what do? They did announce a pause or a skip, although interesting, Chairman Powell was quick to say this is not a skip. And what he meant by that is the Fed wanted to reiterate the fact that while they did pause or skip for June, that they still are in a hawkish stance as it relates to future planned rate increases. Again, we're talking about the Fed funds rate. So in fact, there was a suggestion that they may raise or they could raise the Fed funds rate 2 more times after this month. So in that regard, it became known as a hawkish pause rather than something that is signaling that we're at the peak and the rates are going to start to fall. So, So with that, just be aware that we're kind of in the holding pattern still with rates. Now, what happened today, part of the reason the bond yield dropped today was a couple things. Well, for one, initial claims for unemployment was announced today, and it was higher than expected. And that, of course, has caused the bond market to rally. Bond yields dropping again back to that 372 range when we were looking over 380 yesterday. And then stock market's having a pretty big rally. Why would that be when that would otherwise be considered bad news? Well, higher than expected unemployment claims is a suggestion, again, of a softening economy, possibly recessionary. And when that happens, rates tend to fall. And don't forget last week, our episode when I was out of town, we talked about the cardboard recession. So there is evidence from the cardboard manufacturing sector where there's less cardboard boxes being made. That's an indication of less shipments of durable goods. And so that's another recessionary sign. So we've got some cross signals going on here with the market. And that's why rates have been kind of jumping around where they are, but with an overall sort of a level playing field in terms of rates. So with that, let's get into a couple of things I want to talk about. And a couple of these have to do with some questions we got from a couple of viewers who saw some news articles about the market and about interest rates and about home buying. And the first one was an article that I actually saw myself as well. And it was a news story about Barbara Corcoran. You may have heard of her. She's a celebrity basically these days. She's on Shark Tank. She's got a history. She's been in the real estate business forever. And in this article where she was being interviewed, she made an interesting prediction. And that was that she thinks that in the not too distant future, that home prices may actually go up quite a bit, or as she said, go through the roof. I don't know if that pun was intended or not. So why was that? Or why was it that she predicted that? Well, first, of course, she described the current kind of standoff that we have in the market. Sellers are not selling their homes because most of them have very low interest rates on their current home. Buyers are kind of on the sidelines waiting for either interest rates or home prices or both to fall. So we have this bottleneck. We have this standoff, as she described it. So why is it she thinks that with those conditions, home prices could go through the roof soon? Well, she points out, and I think she may have something here. Rates are going to fall. In fact, when I was at this conference last week, that was a common theme, that rates are going to fall. It's just a question of when. Could be late this year. Certainly, most market observers are thinking that mortgage rates, interest rates are going to fall in 2024. So her point is, if that happens, and when it happens, and I think she believes it will happen, that's going to do a couple of things. It's going to bring not just buyers into the market, but sellers as well. Now, if you have both buyers and sellers getting back into the market because rates have fallen, particularly with the amount of buyers we have, the amount of pent-up demand that we have, that will probably mute any potential price reductions on homes, given that the inventory of homes for sale should increase. Why? Because there's such overwhelming demand that in reality, home prices, if they've already moderated slightly, but they're not going to collapse, because lower rates is going to bring so much demand into the market from buyers that even with more inventory, that's going to help prop up home values. And in fact, in her view, and I tend to agree with her, this could actually be a situation where home values could go up quite a bit, 20% or through the roof, maybe not, but certainly it's going to go up from here. So the other thing she pointed out, of course, is that home prices do vary, and they have fluctuated, but they vary geographically. There's parts of the U.S. where home prices haven't really fallen at all. In the Southwest, Florida, Texas. There's parts of California, certainly in Orange County and LA County. We're still seeing transactions where homes listed for sale of the price right are getting multiple offers and sometimes being sold over list. So the home price and market trends vary greatly from a geographical standpoint. So you got to keep that in mind. There's no catastrophic collapse in home prices coming. Why? Home owners are highly leveraged. They got lots of equity, very low interest rate on their existing mortgage, and there's no foreclosures. So without the foreclosure supply that we had back 15 years ago, there's no catastrophic housing market collapse that's coming. I don't see one on the horizon. She didn't either. Excuse me. So now, given her prediction, and if she's right about this, what should buyers do? Frankly, what should buyers and sellers do, but in particular buyers? Well, in my opinion, buyers should reconsider holding off on a purchase, waiting for rates to fall or waiting for home prices to fall, mostly because while I think they may be right about interest rates falling at some point, with home values probably not falling, they're better off getting into the marketplace now and try to use some of the tools we have. We've talked about them before, temporary buy downs, permanent rate buy downs. Use those as tools to get into the market, look for a home to buy now. When you make your offer, try to include in that offer a request to get some seller help to buy down your rate, either on a temporary basis, 2-2-1, 3-2-1, or a permanent basis. That way it gets you into home ownership now. It gets you into home ownership with a below market rate. And then that buys you time to wait for rates to fall, at which point you can refinance your note rate into a much lower note rate for a long-term position. So, and then by doing that, you'll have an opportunity to take advantage of that upward rise in home values if you get in now. So I would highly encourage buyers in particular, reconsider that strategy of holding off and consider getting in the market now. Contact us, get with your agent. Let's talk about ways that we can structure an offer to get you some below market interest rate for your purchase. That way you can get into home ownership sooner than later. And then if Barbara Corcoran at Shark Tank is correct, ride that wave of upward home values into the future. And then as rates fall, you can refinance into a lower note rate. It can be a win-win for you. So I strongly urge any buyers out there in particular, reconsider your strategy. Maybe sitting on the sidelines isn't the best move right now, and try to consider getting into the market and get a home, owned by yourself. Be able to take advantage of those rates and move forward. So, with that, we'll see what happens. But I do think she's got a point there. Now, one other thing that I wanted to talk about, and this was another article that was on Yahoo Finance recently. And it was an interesting one because the writer couched the article with regard to the challenges baby boomers face in buying or refinancing a home in 2023. And I thought it was an interesting headline, so I definitely did want to delve into it. And I'm not sure why the writer made reference to baby boomers or the silent generation, other than the fact that they are the ones who are going to be encountering these challenges, at least now. But one of the things that struck me was this description, these challenges for more senior home buyers and homeowners are nothing specific to baby boomers or the silent generation. This is a phenomenon that every generation is going to face as they get older. So let's dig into that a little bit. The point of the article was to suggest that mortgage rejection rates rise with age despite higher credit scores. I think that's true. And of course, a couple of reasons there. Now, one thing, the writer, in pointing out the rejection rates, there weren't that, there wasn't that great a disparity. She pointed out that rejection rates for borrowers at all age levels was about 17.5%, and it moved up to over 20% for older or more senior borrowers. So not a real great spread. So there is a little bit of an increase for an older borrower, but not as much as maybe the headline suggested. And of course, higher rejection rate despite higher credit score. Well, that makes sense because loans are not approved ultimately based on credit score. We've talked many times before that you're primarily going to be approved based on ability to repay, or ATR. What this relies on is meeting a debt ratio limit. So you can have an 800 credit score, you can have $1 million in the bank, but if you don't have the monthly income to meet a debt ratio, you could have trouble getting approved for the mortgage. And of course, senior borrowers, senior home buyers will tend to be in a situation where they may be asset rich, but cash poor, income poor. And so that is an obvious reason why you're going to run into more trouble getting approved if you're a baby boomer trying to buy or refinance a home. And it was interesting because the article talked about, trying to talk to a lender, like ourselves, who understand the nuances of retirement age income. Well, I kind of chuckled at that a little bit because there's not really that much nuance to it if you think about it. For one, as I've observed over 4 decades of being in this business, less and less do we encounter a home buyer or a homeowner, a borrower who has, a pension income. Like maybe they worked for a corporation for 30 or 40 years and then they retired and they got a pension that's a lifetime pension, and then maybe it's 80 or 90% of what their salary was. That's getting to be less and less common. We just don't see that as often. And to the extent we do, we tend to see it more from public employees who are usually getting those kind of pensions. But for the majority of the population, those are getting to be very rare. So, of course, the nuance of being retirement age is your income is likely going to drop. Why? Because you're going to retire from your job, and you are going to be relying on retirement income, most commonly Social Security, which obviously is most cases going to be much lower than what your employment income is. So from that perspective, yeah, there's a nuance there that we have to address. Excuse me, but there's ways to do that. For example, there are mortgage programs and mortgage underwriting approaches that will allow us to calculate a borrower's income based on how much cash they have in the bank. And we can calculate an assumed income by taking their liquid assets and dividing it over the loan term, like 360 months. Another thing we can do is if a borrower has retired and they have a substantial IRA account and they're of retirement age, even if they're not drawing on that IRA account, they can set up a monthly distribution. They can talk to somebody like us and we can advise how much that monthly distribution would need to be to meet a debt ratio. And then they can set up that distribution. Once that's verified, they've received the first monthly distribution, we can get that loan closed, and they can get that loan that they otherwise may have been told they couldn't qualify for. And then one other thing I wanted to mention too is this article, talked about denial rates for HELOCs and cash out refinancing. And that the denial rates were lower for senior borrowers, for baby boomers, than for cash out refis. Well, that kind of makes some sense. Why? Well, the most obvious thing is a HELOC, in most cases, the HELOC transaction is generally a much more modest loan amount. Whereas a cash out refi, that's usually going to be refinance of your first mortgage, that's typically going to be a much bigger loan amount where you're going to probably run into more issues regarding that debt ratio limit that you have to meet. So then in that regard, one other option or alternative for an older borrower, there's actually a couple when they're dealing with this this challenge of being able to buy a home and get a mortgage or be able to refinance their home. There's a couple other things to keep in mind. Fannie Mae, for example, has a program called Refi Now. This was a program that was actually developed a couple of years ago, and it was specifically designed for any homeowner who's got a loan now in their home that's owned by Fannie Mae. And if they meet having income within certain limits, like 100% of adjusted median income, then they can actually get a refinance done, no cash out, but they can get a refinance done with a rate that's going to be about 0.5% lower than market. They're going to be allowed to have a debt ratio as high as 65%. And they can also get a credit of $500 toward their appraisal costs. So there is a program out there to meet the challenges of a baby boomer borrower as it relates to a no cash out refi. Of course, right now we're in the conditions where there's not a whole lot of no cash out refis being done to lower your rate, given where rates are at. But understand that's a product that's there, and that we do use it from time to time when need be. And then the other most obvious thing to consider for a baby boomer borrower is a reverse mortgage. Those are qualified in an entirely different way. Of course, the article mentions that with reverse mortgages, the decline rate tends to be higher the younger the borrower. That's obvious because you have to be 62 to be eligible at all. But otherwise, if you're over 62, and certainly if you're a higher age, maybe approaching 70 or into your 80s, a reverse mortgage is a good way to get around some of the challenges of being a baby boomer borrower, because you're qualified in a much different methodology. You're not qualified based on the debt ratio. In fact, you're not even qualified based on a minimum credit score. So we do have some alternatives. So if you are a baby boomer, a silent generation borrower, you need some help, navigating some of these restrictions, feel free to contact us and we'll be happy to help. So with that, I want to shift gears here now and talk a little bit about, I'm calling it a case study. This is actually a transaction that we're working on now. And it's a very interesting one in regards to, in this particular case, it's a first-time home buyer. And this home buyer was looking at deciding on whether to use a conforming 97% program, that's a Fannie Mae, Freddie Mac purchase money loan with 3% down, or whether she should use an FHA loan with 3.5% down. Now, in the past episodes and some of our other videos, I have talked about many times how I have always thought FHA for first-time home buyers in particular is a better way to go, particularly if you're a little bit more challenged on credit score, below 700, below 680. FHA is almost always going to win out compared to a conforming 97% conventional loan in terms of how it's priced. So let me show you how now this is true even if you're at the highest credit score level. And here's an example. Purchase price $645,000. Credit score was 780. Again, this is a first-time home buyer. And so what we did is we compared a conforming 97 and an FHA based on these parameters. And here's what we found. The FHA loan at that $645 price, the principal and interest payment was $3,645. The conventional 97 loan, the principal and interest payment was $3,903, quite a bit higher. Why? Rate differential. The rate differential between the FHA and the conforming 97 was about 0.75%. In other words, FHA had a 0.75% lower rate than a conventional 97. Then the other component that's going to determine the housing expense per month is the FHA mortgage insurance for this transaction size, $283 a month. The conforming 97 mortgage insurance, $302 a month. So the FHA mortgage insurance is actually lower than the conventional 97 mortgage insurance. Now, why is that? That didn't used to be the case. Well, if you recall, FHA annual mortgage insurance used to be 0.85. Recently, earlier this year, it was dropped to 0.55. So now FHA annual mortgage insurance is highly competitive with, and in many cases, lower than a conventional 97 loan program. So that didn't used to be the case, and that's another benefit of FHA over the conventional 97. Now, you might say, for those of you who know a lot about FHA loans, well, wait a minute. FHA's got an upfront mortgage insurance premium of 1.75% of the loan amount, which is a big number, right? Now, that's a one-time upfront premium. So what about that? Wouldn't that undermine the FHA advantage over the mortgage insurance cost? Well, yes and no. I mean, the 1.75 cost is there. However, if you go back to that second bullet point, the FHA principal and interest payment, which is lower than the conventional 97, that already takes into account the upfront MIP of 1.75 because that's financed into the loan amount, and the principal and interest payment for the FHA includes that upfront mortgage insurance cost in the monthly payment. So even with the upfront 1.75, because of the lower rate the FHA loan has, the principal and interest payment is still, what, $250 a month less than the conventional option. So overall, the FHA option provided this borrower, almost $300 a month in lower housing expense. So obviously, you can imagine that was the choice, that was the loan product chosen by this borrower. And now, you might also say, though, well, wait a minute, with conventional 97 mortgage insurance, you can get that canceled after a couple of years, minimum of 2 years or longer. FHA, it goes on longer. Yes, that's true. However, the obvious alternative to that is when rates do come down, that borrower can then refinance out of the FHA loan at the point where they have enough equity, they can go into a conventional loan with no mortgage insurance at all. So that would be the backup plan. And so the overall point of this case study, it's a real life example of a new transaction I'm working on now, where at any credit score level for a first-time home buyer, whether you're in the mid sixes, you're at 700, even if you're at the highest 780, FHA is almost always going to win out over a conventional 97. And of course, keep in mind, an FHA loan is not a first-time home buyer program. It's available for anyone. So warm up to FHA. It's your best choice if you're a first-time home buyer or anyone who's looking to go with a minimum down payment when you compare the terms for FHA to a conventional agency, Fannie Mae, Freddie Mac type loan. So keep that in mind. Happy to give you any numbers if you like in the future if you're looking to get looking at a transaction where you need a minimum down payment and you're trying to decide between FHA or conventional. Okay, so with that, I want to go into our closing question of actually the week before last that I had left you during this show. And if you recall, what the question was, what is the minimum credit score required by Fannie Mae, Freddie Mac to be eligible for a conforming loan to refinance or purchase a primary home? Well, you might be interested to find out that the answer is none. That's right. Fannie Mae and Freddie Mac no longer have a minimum credit score for a mortgage if used to refinance or purchase a primary home. That didn't used to be the case. The minimum credit score used to be 620 with both agencies. Now, is 620 still required? Yes, it is required still for second home or investment or rental properties. Minimum score is still 620. Now, be aware, some lenders, even though Fannie, Freddie do not have a minimum credit score requirement for a primary home refinance or purchase, some lenders may still use a 620 minimum. That's called an overlay. A lender has the ability, the discretion to do that. So you want to check around, make sure if you do have a credit score under 620, that you check with a lender who can help you and has financing for that situation. And we do. In fact, we have several lenders where we can arrange your loan if you're under 620 on a primary residence. Now, what's very important about this, and it kind of brings up a kind of an old concept that we don't see too much anymore, but it's one called compensating factors. So what I mean by that is, if you are a borrower and you're under that 620, maybe you're at 595, 590, 585, and you still want to look into getting a conforming loan, you may be able to get approved, even because even though you're under 620, since the agencies don't require 620, you may be able to still get approved. However, we have to look at your overall application and see if you've got other what's called compensating factors, or another way to think about it is other strong points to your application, your financial profile that would compensate for the fact that maybe your credit score is a little bit challenged. That would be things like you've got good income, so your debt ratio is well within limits. Maybe you have a lot of liquid assets. You do have money in the bank, so that even after your down payment, you would have a lot of money left over as what we call post-closing reserves. You, even though your credit score may be a little bit challenged, if you have a modest amount of credit obligations, that can help. So keep in mind that if you are under 620 and you still want to investigate if you can get that loan, particularly a conventional loan, and particularly if you're putting a sizable down payment and you want to avoid mortgage insurance, just keep in mind that you have to have other strengths to your financial profile to help compensate for that lower score. And we can help you determine if that's something that you're going to be able to meet and be eligible for. Just give us a call and I'd be happy to go over your actual situation. So with that, I want to finish up here with our closing question for next week. And this one's kind of timely. I've run into it quite often, and I'm sure a lot of you may have some notions about it. Here's the question. Does shopping for a mortgage hurt your credit score? So interesting question, comes up all the time. I'll talk about this in detail next week at next week's episode. So in the meantime, ponder that and just keep in mind that once I provide you this answer, it will be an answer that will be on the house. And with that, back to you, Jeff.
Art, that was a great information. It reminds me as a kid going to the store with my mom, and as a kid, you see all the great stuff that should go in the basket, and she's shopping for things for the week. And you gave us a range of. There was some news that was not so good, but overall, especially topping it off with Barbara Corcoran and her prediction, it could lead to very positive results for us as homeowners or people who want to buy or sell a home.
Well, yeah, I think so. I mean, that's something that I've been observing now for quite a while here. I mean, mortgage rates have run up. I think the extent of the run up has really run its course for the most part. I mean, we would need to have some, pretty some sort of shock event that might change the current conditions. I think the point of it is that for a home buyer, I think there's opportunity that they may be missing because rates have moderated. We're not seeing that rate of increase has definitely subsided to the point where, while the Fed is still trying to keep this hawkish posture in place, I really do think we're kind of reaching the peak. We're reaching that plateau. And in my mind, what I worry about is I've pre-qualified a lot of home buyers. Many people in my industry have. We all talk about it. It's like we've got all these buyers we pre-qualify, but the buyers are generally just in a holding pattern. And I fear that they're going to miss an opportunity. There are tools to get around this 6% interest rate level that we're at. We've talked about it a lot with these buy downs and so forth. I just think a home buyer is better served if they're in a position to buy and they think they can qualify. And of course, we can help determine that. I think they're better served to jump in now. Don't wait. Use the financial tools we have to get that rate subsidized for the first couple of years so you get some payment relief and then be well positioned as a homeowner to take advantage of that predicted increase in values once rates do fall and we see even more and more buyers jump into the market, and there'll be more homes to sell or to buy because more sellers will get into the market and sell their home and then move up to buy a move up home. So I think that's the opportunity. I think, therefore, buyers should not wait. They're better off pursue a home purchase now, not later. So, despite conditions.
Yeah, it makes so much more sense because as you cautioned us 4 or 5 weeks ago, I said, beware of the headlines. These people they're trying to scare everybody. I mean, I see it pop up now and then, like, predictions that 10% is going to be the new normal for home loans. I'm like, I don't think that's going to happen, but it has a lot of people on edge. The whole idea of what you're talking about, and it kind of excites me from a standpoint of, somebody does a buy down for, was it 3-2-1, and all of a sudden they can take advantage of this. But I think the thing that might have been that missing component was the fear that housing prices were going to drop and then they were going to be stuck, and in 2 or 3 years, or in 2 years, the value hadn't gone up enough to refinance it. But it sounds like that's not going to be the case.
I don't think so. I mean, the conditions just aren't there. We have very little inventory. We have very little in the way of foreclosure activity. The current housing stock is comprised of homeowners who are well qualified for the mortgages they have. They had to meet all of those ATR, all those ability to repay guidelines and debt ratios and so forth to get their loan, which was not what we were doing 15, 20 years ago when you fogged a mirror and you got the loan, right?
Right.
The homeowners, the home housing stock, the homeowners now are well qualified for the mortgages they have, and they're at very low rates. As a consequence, even when rates fall, yes, there'll be a lot more homes that'll hit the market because those sellers are anxious to cash in on that equity and maybe move up, buy that next level house. But that phenomenon is not going to create that glut in the market to where everybody's home values are going to fall. The data just isn't there to support it. And so that's why I think home buyers, prospective home buyers who are waiting for home prices to fall substantially, I think, again, they're trying to time the market. And I'm going to predict that they'll be wrong on that. They should get into home ownership now, get their rates subsidized, and that way they're going to see better equity growth in the future, and they'll still have an opportunity to refinance that note rate into a better level later on. So
I think it's a good play. Hey, for those of you that are saying, hey, this makes sense, and as you say, the data supports it. Pardon me. Now I'm catching the art throat there. You need to call Art. It's time. I just checked, and it's a perfect season. It's summer. It's time to put on your suit and get in the pool and get involved in this and take advantage of it before the water turns cold again. So you can get a hold of Art at MortgageWorks at 760-883-5700. That's the office. But if you want to talk to Art directly, then just call him on his cell phone at 714-612-9035. And of course, you can always go to the website. You saw that at the very beginning at mwloan.com and see what the rates are. Check out those buy downs because that may be your actual key to open up the door for opportunity for you. And go ahead and say yes to that dream home and let Art help you put that together. You can always contact Art on his email at art@mwloan.com. And as we say, hey, he's here there every Thursday at 2:00 and to give you the latest on what's going on in the home loan industry. And, Art, thank you so much. Like I said, I think this was a perfect mix. And as far as nutrition is concerned, it was a perfect mix of nutritional value for us as homeowners or sellers, first-time buyers, doesn't matter. It's time to get involved.
Yep. Sure is, Jeff. I agree with you. And looking forward to next week's episode. And just remember, at MortgageWorks, we have the answers and they're on the house.
Let's call Art, see if you can get this squared away. Everybody, have a great week. We'll see you next week. Thanks.
All right. Thank you, everybody.